Hello everyone, good morning, good afternoon, good evening, depending upon when you are watching this video lecture. After the completion of discussion related to capital budgeting or investment decision making, let us move on to an extension of that topic, risk analysis in capital budgeting. Of course, this topic also uses the same techniques which we learned in the topic of capital budgeting. But only point is, here in this chapter, we will focus on the main aspect, risk. So this topic will tell us about what is this concept of risk and uncertainty and how is it related to capital budgeting, why is it more important for capital budgeting, and what are the sources of risk, generally theoretical discussion or conceptual discussion. What are the reasons for doing some adjustments for risk in the capital budgeting? These are all theoretical things, but most importantly, problems wise, this is the main thing. Various techniques used in risk analysis. So once again, this is where the problems will be asked from. That is the techniques. Various types of techniques are there. That does not mean there are new techniques of capital budgeting. No. Techniques of capital budgeting which we are going to use here also will be same. And most popularly, naturally, the technique which we use quite often here also will be Npv. But how that has to be adjusted, how Npv has to be reassessed, introducing risk also into the computation is the main point here, and for that there are various techniques which are used, which we will learn in this chapter. And again, theoretically, what are the various concepts, advantages, limitations of all these techniques in the topic of risk analysis in capital budgeting. That is the objective or learning outcomes of this particular chapter, risk analysis in capital budgeting. Of course, broadly, this topic is mainly covering different types of techniques, some of them statistical techniques, some of them conventional techniques, and some other techniques also. We will discuss each of them in this chapter. But first of all, before going to the techniques part, let us understand why risk plays a crucial role in the capital budgeting. First point, we are talking about future. Whenever we talk about future, there is no way that we can tell exactly what happens in future. Nobody in the world can do that. So naturally, there will be an element of uncertainty which will definitely convert to risk also. Second thing is, these topics are the kind of estimates that we are making, all of them are long term in nature. Means yes, they are into future, but not near future. They are into far future. That means naturally uncertainty will be more, risk will be more also. So major reasons here can be looked at from the point of view of projections that we are making into future, that too for a longer term, automatically bring risk into the capital budgeting analysis. But not only that, there is risk in every estimate that we are making, because everything that we are using as input for the purpose of computation of various things in the capital budgeting is an estimate only. Cash flows are estimates. Scrap value at the end of the life is an estimate. Life of the project or life of the machine itself is an estimate. The discount rate, required rate of return, or cost of capital itself is an estimate. So everything is an estimate. When we are talking about everything as an estimate, that estimate can go wrong also. That automatically means there is risk. So definitely investment projects are exposed to various degrees of risk. Broadly, we can classify the decision making into three categories. Decisions which are made under certainty, with certainty, where the cash flows are certain. Decisions where there is risk involved, means there is a risk and probability can be assigned to that risk. And decisions which are made under uncertainty, where the cash flows are uncertain and probability cannot be assigned also. As the topic of risk and uncertainty is there, they are related with each other, no doubt. Risk and uncertainty are related with each other. Uncertainty definitely leads to risk, but risk is not only about uncertainty. Risk is a bigger thing. Uncertainty is normal because of anything related to future. That need not be long future. Even for near future also, everything is uncertain. Certainty is a myth in reality. However, with that exception or with that excuse, we can say anyway this is all uncertain, so we don't need to analyze. No, we cannot do that. So definitely what any company has to look at is bring that uncertainty to the least amount possible with better experienced professionals working on these things. Still, that does not make any 100% guarantee, that does not give any 100% guarantee that all the estimates are certain. So, point to be noted here when we look at these words risk and uncertainty. Uncertainty is inevitable, that is always there. So, wherever there is something that we are talking about future, there is uncertainty. But point is, this uncertainty is not something that can be quantified. So, uncertainty is not possible to be quantified. But uncertainty leads to risk, that is for sure. In simple terms, to cut all this roundabout discussion, uncertainty is not quantifiable, risk is quantifiable. So, uncertainty is a concept, risk is a measurement. That's how we can understand these two things. But in spite of that, certainly both these two things are very, very closely related to each other. So that is the point. Uncertainty can be, we can say, subjective. Risk is objective because it can be measured. It is a different discussion whether the risk measured is absolutely correct. No. But there are techniques at least to do that measurement. So that is the core difference between them. However, as far as our topic of risk analysis and capital budgeting is concerned, we don't differentiate between these two words. Both are used interchangeably, though they are not exactly same, but they are very closely related to each other. So that is the main point here to be noted. One of the terminology related things. Then a question comes, what is risk? This is the biggest point always to be known, particularly at final level in chartered accountancy, SFM and other aspects. Even in management accounting, performance management aspects also, there will be risk that will be inherent topic at many places. You will learn the advanced topics of them in final, but at this juncture in CA Intermediate, what we just need to understand is logically, conceptually, risk is something where there is a possibility of deviation from the plan. So if you have a plan to go like this, if there is a possibility of deviating from that plan, that is risk. So anything that is not in line with the original plan, forecast, projection, budget, whatever we call it, is a risk. That is the core concept of risk. But why we need to do this adjustment for risk in capital budgeting? First point, when we invest in big projects like long-term investments which are going to be made in this capital budgeting topic, there has to be always a balance between risk and return. Maybe a project is giving a very good return, but if it is equally very highly risky, then it may not be really good to go with that. Again, it may not be. Nobody can say it is not. Because whenever we say risk, though it is measurable, though it is quantifiable for our 5 marks questions, which we do anyway, in reality, once again, is a perception. And responses to risk also will be different. They need not be always same. There will be always kinds of people, types of managements, types of companies, corporate culture of each of the companies will not be same. Some companies are risk mongers, means they want risk. They are always playing on the risk. Such kind of people are there. Some people are risk averse. Certain companies are very conservative. They are risk averse. And some companies are risk neutral. So the response to this risk will not be same. But fact is there is risk. To that extent we can understand. But we should not get into the response to the risk also. We cannot take it onto our shoulders at this juncture because we are not the ones to decide the response. That will be decided according to the corporate philosophy or the style of the management. Sometimes if the CEO changes of a company also, the response can change. Not necessarily the company itself is having an ethos for itself. But nevertheless, fact is that there is risk in every decision that anybody takes, and always the decisions have to be made in such a way that risk and return are commensurate with each other. They have to be proportionate to each other. There should not be a huge risk taken for a little return, or there cannot be a situation where no risk is taken, where there is no return. Then there is no point of operating the companies. So there has to be a risk-return balance, which is important. That is why risk is definitely to be considered while taking decisions. And one more thing is, risk will bring what is the real value of the cash flows. Higher the risk premium, and naturally the expectation of higher return will be there. So this is one point to be remembered when we discussed and understood about the time value of money also. We talk about discount rate. What is this discount rate at which we are discounting all the cash flows? It could be anything. Basically, it could be weighted average cost of capital, marginal cost of capital, required rate of return, sometimes called desired rate of return, sometimes called, now we can get into risk adjusted rate of return or risk adjusted discount rate. But certainly one point is guaranteed, whether we can actually dissect it or not. But the discount rate, including whatever it is, even if it is just the cost of capital also, it consists of three things. We discussed that earlier also. One of them is interest, second one is inflation, third one is risk. For sure. We may not be able to find it. But it is there. You see water, that is a mix of hydrogen and oxygen. We know that, everybody knows that, H2O. But show me hydrogen separately, oxygen separately in that, not possible. But both are there. Same way, whatever the discount rate we are using, it includes already inherently all the three. So risk is definitely one of the components. So that is why, if there is a possibility of evaluating two projects, let us say A and B, same company is investing, same amount of money is getting invested, same amount of return will come also in terms of the cash flows. But if, let us say, project A is highly risky, project B is less risky, then the company will automatically expect more return from A than B. So higher the risk, higher the expectation. Higher the expectation means what? Automatically higher the discount rate. So the discount rate what we are going to use can be adjusted for risk. That is a simple technique called as risk adjusted discount rate. So the adjustment of risk can be done to the discount rate itself. And at a broader level, if we observe in the capital budgeting, particularly Npv is the main core technique. What are the two major things that will be inputs? There are so many things actually, including initial investment, scrap value, life of the project, tax rate, depreciation rate. All of them are inputs. But majorly what are the inputs? Majorly cash flows, then discount rate. These are the two things. So for a simple understanding, at least to start with some of the traditional techniques in this chapter, we can say this adjustment for risk can be done either in this level or in this level, not both. Not both, only at one level. Let us say if a project is more risky, you can say, okay boss, I will discount the cash flows with a higher rate of return. Normally my regular required rate of return is 15%, but imagine I am evaluating a project which is having more risk involved in that. Now my expected rate of return will be 18%. So what is this 3% extra I am expecting? That is called as risk premium. That is a premium I want to charge for the risk that I am taking because of this riskiness of the project. So this risk premium can be added to the normal discount rate so that we get risk adjusted discount rate. We got one technique already. That is one of the techniques. So what is going to happen there? Simple. We are going to change the discount rate and calculate the NPV at the risk adjusted discount rate rather than normal discount rate. How to do that? Add risk premium to the normal discount rate. Of course, all of that will be given in the question. All that you need to do is calculate risk adjusted discount rate, then apply that risk adjusted discount rate on the normal cash flows, not risk adjusted cash flows. Once again, I am repeating, adjustment for risk can be done either at the cash flows or in the discount rate, but not in both. Double adjustment is not correct, not appropriate. So if the adjustment for risk happens at the discount rate level, that itself is called risk adjusted discount rate. If it happens at cash flow level, there are so many other ways of doing it. We will come to that also. So the risk premium normally is definitely going to be added for the projects which are highly risky. That is the reason why risk has to be adjusted in the capital budgeting, because it is quite natural. When there is more risk involved, return expected will be also more. That is a simple logic which is applicable for this particular topic. Then there are different sources of risk. We can generally go through them. The certain risks are project specific risks which are related only to that particular project. Certain risks are related to company which is actually undertaking this project. So some project specific risks will be there. Company specific risks will be there. Industry specific risks will be there. All industries will not be of same risk. They will have different risks. Like for example, infrastructure or real estate industry is more risky. It is the nature of that. FMCG, for example, is less risky compared to the real estate sector. So certain industries are more risky, certain industries are less risky by nature. So there is industry specific risk also. Company specific risk will be according to the company's performance and other company related, company level, corporate level, general culture and management style. All those things will definitely bring company specific risk. Project specific risk could be related to the project itself. For example, let us say a nuclear power project is supposed to be constructed. Yeah, it involves a risk automatically. That is definitely more risky than a normal hydel project. So every project will have its own type of risk. That is project specific risk. Company specific risk will be related to the company as a whole, mainly the management, we can say. Industry specific risk can be related to the industry in which the company is operating. We are going broader. First project level, very specific. Company level, little bit broader. Industry level, much broader. Market risk is broadest. We are talking about the external environment, which could be related to the economy, demand and supply of resources, availability of resources. All these things will be market risks. Those are in the overall market in which the company is operating. Then there will be risks from competitors also, naturally. Imagine if a particular company started a fantastic project, thought that it was fantastic, but competitor started a much better project than this and became successful. All the investment is gone. So naturally this type of situations happen because of the very dynamic changes in the tastes and preferences of the consumers also. That is there. Then economic conditions also can have an impact, including inflation, interest rates, government policies like taxes. Let us say when we projected our cash flows, let us say there was no particular tax. After the project is implemented, a new tax is introduced. All our assumptions, all our calculations went for a toss. This can happen in just one shot. Maybe one ordinance by the government is enough. They will ratify it in the parliament later. So that is always there. Regulatory risk is always there. Government risk, risk from the government policies is always there. Economy related risks, interest rates can change. We expected, let us say, interest rates are basically 6%, and because 6% is normal interest rate, let us say risk-free rate, because we want little bit more amount than that, because this is equity generally that is getting invested into these projects. Say another 6% we added and we wanted 12%. Maybe for risk premium another 3% we added for the project specific risks, etc. We expected 15%. All these things are okay. But what if the interest rates base itself went to 8%? Then this went for a toss. So we calculated NPV of a project, let us say, at a 15% discount rate. It was positive. We were so happy. We accepted the project, started it. While it is going on, this became 17%, our actual cost of capital or the required rate of return. Then the NPV can go to negative in reality. That means either is a deviation from the plan, that is risk. This risk can happen due to the changes in interest rates. Inflation is a very big role in the economy. Government regulatory policies, all these things can have huge impact on the project success, and all of them are risks. And international risks are also there. International risks, including the global pandemic that we have, that has become an international risk. Free trade restrictions and wars, sometimes geopolitical tensions, all these things can be suddenly changing the overall projections that a project has originally estimated. So all of them are possible. Of course, beyond that also many other risks are possible. So these are just for general understanding what could be the sources of risk generally. This can be a theory question. So you have to remember this list. 4 or 5 marks theory question can be asked. Don't write stories, just a simple one liner explanation is enough for these headings. Project specific risks, company specific risks, industry specific risks, market risks, and competition risks, economic risks or risks due to economic conditions, and international risks are also possible. So these are all possible areas where from any projection that we did with a lot of hard work can go for a toss just like that. That is the problem. So risk is there in any investment, naturally. That is a point to be understood. Why? We already looked at. Because we are talking about future. Also that future is not very short-termistic. It is a long-termistic future. Naturally there will be more uncertainty which results in more risks. And anything can happen in between. Any of the things that we discussed about sources of risk can happen. All of them are possible. But because the topic has come, let us understand one thing. Risk is a negative word. So we talked about deviation from the original plan. Just for example, let us say I have expected that there will be 100 crores of NPV from a particular project. If it actually delivered 108 crores of NPV, that is not called risk, though it is a deviation. That is not called risk. So we are not talking about a positive outcome. Risk means always a negative outcome. Today it will not rain is not risk. Today it will rain, it might rain is risk. The power cut will not happen is not risk. Okay, let it not happen, that's good. But power cut will happen, might happen, that is risk. So always risk is to be perceived and understood in a negative sense. Though it is a deviation from the projection, that is not a good deviation, it is a bad deviation. So what kind of possibilities are there? What kind of techniques can be used for the risk analysis in capital budgeting? As we just now understood at a broader level, 3 types of techniques are there: statistical techniques, conventional techniques, and some other techniques also are there. Let us first move on to the conventional techniques, because they will give better understanding and quick understanding of the concept of risk, relatively easier also. So what are the conventional techniques? Just now as we discussed, one of the most popular conventional technique is risk adjusted discount rate. It's very simple. What is the logic behind this concept? Naturally, anybody will expect higher returns from risky projects. which means the required rate of return for any project or any investment should be in line with, it should be in line with the risk that is involved for a similar kind of project. So discount rate is the main point here. We are talking about a risk adjusted what? Discount rate. So where the change will happen? Only in the discount rate. So less risky project, less discount rate, more risky project, more discount rate. And we are not nothing new with this formula. NPV formula is that only. Cash flows divided by 1 plus k to the power of t minus initial investment. That is NPV. We know this formula. But what is k here? Or as we looked at earlier, that is risk adjusted discount rate, not the normal discount rate. Don't think we are going to do some great calculations for the purpose of risk adjustment. Everything will be given in the question. All that we need to do is just use the data and calculate NPV according to the risk adjusted discount rate. So what is risk adjusted discount rate? Simply risk free rate plus risk premium. So whatever is the risk free rate, it will be given in the question, plus risk premium. Mostly it will be given in the question. If it is not given in the question, there is a way of calculating it. That is a separate discussion altogether. Capital asset pricing model. We'll come to that in the cost of capital chapter. That is different. How to calculate this is always cost of capital. So far whatever we are talking about discount rate is all cost of capital. So cost of capital is a different topic. But concept is same. Concept is what? Any project which requires more return because it is more risky should be definitely discounted with a big discount rate or bigger rate of return being expected from such project. So how to get that? It's a simple logic. Whatever the risk free rate is there plus the risk premium will give us risk adjusted discount rate. So what is risk free rate? Risk free rate is generally that which bears no risk. Is there anything like that in the world? Generally there is nothing, but for our convenience we have to take government securities. Generally are taken as risk-free securities. Why? Because individuals, companies, corporates may default. Government generally cannot default. If a government defaults, that country is gone. Are there not such countries? It's a different story. But in general, we are not talking about such exceptional governments. Normally, all the governments in the world, in generally civilized countries and reasonably well-established economies in the world, including India, definitely it is expected that government will not become bankrupt. Government will not become insolvent. With that expectation, at least we can say government securities are risk-free. That's an assumption. Reality may or may not be same. That depends upon many other factors. But we have to assume that government securities are risk-free. So if at all government securities are giving 6% rate of return, that is the risk-free rate. Simple. So risk-free rate, if at all it is given in the question, government securities, sometimes called G6, or T-notes, treasury notes, or T-bills, treasury bills in India which are issued by RBI. So these are all considered to be risk-free securities. Whatever the return they offer, that is called as risk-free rate of return. Plus the risk premium has to be added. This is the biggest question. How much to be added? That we don't know. We can only just generally tell the tendency. Higher the risk premium. Lower the risk premium. That's all. How much? That depends upon the realities. So can we get into realities and calculate? No. So what is our advantage? That will be given in the question. There is no other option. So simple. That is risk adjusted discount rate. Let us apply this in illustration 5. An enterprise is investing 100 lakhs rupees in a project. Risk-free rate of return is 7%. Risk premium expected by the management is 7%. So simply, all that we need to do is we have to discount these cash flows at 14%. 7% plus 7%. Life of the project is 5 years. Following are the cash flows that are estimated over the cash flows are directly given over the life of the project. 1, 2, 3, 4, 5 cash flows are given in lakhs. Calculate net present value of the project based on risk-free rate, also on the basis of risk adjusted discount rate. So 5 marks question. 2 NPVs you have to calculate. That's all. One NPV with risk-free rate, which is 7%. Another NPV with risk adjusted discount rate, which is 14%. So let us do that. Nothing special here. Here, cash flows, PVIF. PVIF, let us take 2 things. One is 7% and second one is 14%. right? Then DCF, discounted cash flows at 7%, and discounted cash flows if the cash flows are discounted at 14%. We can do directly, there is no need of two tables for this. So here 0, 1, 2, 3, 4, 5, that's all. 5 years are there. Year 0, what is the investment? All rupees in lakhs. So we can just write here. All rupees in lakhs. Now cash flows. Year 0 minus 100. Year 125, then 60, 60, 75, 80, 65, 80, 65. Done. Then PVIF, of course, in exams usually it should be given. If not, also you should be able to calculate. For year 0, 1. Naturally, for year 0, whatever the discount rate will be, it will be 1 only. So cash flows multiplied with this will be same, minus 100. Cash flows multiplied with this also will be minus 100. So year 0, there is no issue. Year 1 to 5, we need PVIFs. So let us do that. 1 divided by 1.07, 7%, right? 1 divided by 1.07. Now that divided by 1.07 and so on. So you can refer to tables also, or you can simply compute without wasting much of time. Next, what about 14%? 1 divided by 1.14. That divided by 1.14 and so on. So these are the PVIFs at 7% as well as 14%. Then all that you need to do is multiply the cash flows with the PVIFs. So simply we can have the two decimals is better, at least because rupees in lakhs are there. Then after the multiplication, total as usual, simple calculation. So at 7% discount rate, which is risk-free rate, NPV of the project is 144.4 approximately, and at 14% discount rate, NPV of the project is 99.85 approximately. That is the answer. That's what is asked. So 144 point something, 99 point something. That change will be there as usual because of rounding. That's it. That is risk adjusted discount rate. What is there in this? Nothing. All that you need to do is do an adjustment to the discount rate according to the information given in the question and recalculate NPV. That's all. 5 marks questions can be expected on that. What are the advantages of this technique? Of course, it is easy to understand. We can easily understand that, and it incorporates a risk premium in the discounting factor. But what is the limitation is how much should be the risk premium? That is the biggest question mark in real life. For you, it is not a problem because it will be given in the question. And with NPV is, though it is calculated, we cannot calculate standard deviation and all that. So there is no measurement of risk here. Risk is already included in the analysis, yes. But what is the measurement of the risk? That we don't know. The measurement of risk practically is only standard deviation. But that is not calculated here because it is a different technique from standard deviation. Standard deviation also can be calculated, which we will discuss later. Those are statistical techniques, which is also part of this risk analysis. We will come to that later. Let us first complete the simple and conceptual aspects. Traditional techniques we can call them. Now, certainty equivalent method is one more traditional simple method. Here also there will be a certainty equivalent which is attached to each of the cash flows. Then that certainty equivalent is multiplied with the normal cash flows. So that what happened? Now we have risk adjusted cash flows. As I told already, risk can be adjusted with the cash flow level or discount rate level. One of them we did already. That is risk adjusted discount rate. That is done. At a cash flow level, how to do that? Okay, let us say cash flows. What are the nature of the cash flows normally? Normally the cash flows, are they certain cash flows? No, normally they are not certain. So we call them uncertain cash flows. Whatever so far we did, all are uncertain cash flows. Now we want to make them certain. We want certain cash flows. How? Simply multiply with certainty equivalent. Who will give that certainty equivalent? For you, it will be given in the examination. In reality, nobody will give, so that is why nobody uses this technique. But in examinations, this will come. So for you, it is a simple clerical exercise. Cash flows will be given, certainty equivalent will be given. All that you need to do is multiply these two so that you get certain cash flows. After that, what you should do? Same PVIF, then same discounted cash flows, same NPV. Everything else will be same. Only difference is the uncertain cash flows. Normally, what we use have to be converted to the certain cash flows by multiplying with the certainty equivalent. That's all. That is a certainty equivalent technique, which is bringing risk into the cash flow level, not a discount rate level. But point to be noted, once you have introduced already risk in the cash flow level, you should not introduce risk in the discount rate level. That is why when certainty equivalent approach is followed, what should be the discount rate we have to use? That should be risk-free rate. You should not use normal discount rate. You have to use risk-free rate. That means the government securities return is the discount rate which has to be used. So this is the main point where people might do mistake. Certainty equivalent multiplication everybody will do. In the question, risk-free rate also will be given, and risk-adjusted discount rate or normal discount rate also is given. So which has to be used? Normal discount rate as we use regularly? No, it should not be used. Risk-free rate has to be used because already we adjusted the cash flows by multiplying them with the certainty equivalent. We made them what? Certain cash flows. They have to be multiplied with risk-free rate. That's it. That is certainty equivalent approach. Steps and all these things not required, because end of the day what we are going to do is a simple arithmetical calculation. So what is this alpha and all that? Whatever it is, that is the certainty equivalent coefficient. How do you know that? Alpha and all. Are we going to calculate that? Nothing. We cannot do that. In fact, that is altogether a different exercise. If at all we have to do that, that is none of our business. Simply all that we need to do is multiply the expected cash flows with the certainty equivalent coefficient, which should be and will be given in the question. There is no way that we can calculate certainty equivalent. We can have probabilities. That also probability we cannot calculate. We will only multiply that so that we get equivalent points. So the application here is basically on the basis of certain things which are already there. In the case of earlier risk-adjusted discount rate, risk premium is something which is question mark. In real life, nobody will tell that. Here, certainty equivalent is question mark. In real life, nobody will tell that. But for you, both of them are not a problem because both of them should be given in the question. In risk-adjusted discount rate, you will add risk premium to the risk-free rate of return, then recalculate the NPV at a risk-adjusted discount rate. In certainty equivalent method, you will not adjust the discount rate. You have to use the same risk-free rate of return. But cash flows are adjusted by multiplying them with certainty equivalent coefficient. That's all. So now let us apply this certainty equivalent method. This is also given earlier. Simple, but proper presentation and calculations and accuracy will give us full marks. Investment proposal of 45 lakhs is there. Risk-free rate is 5%. Calculate NPV under certainty equivalent technique. So all that we need to do is once again same. This no, I will not rupees in lakhs. So let us just take the format and change the cash flows, PVIFs, etc. So what is this percentage of return here? 5%. So PVIF has to be calculated at 5%, 1.05. Okay, that is first point. So this is 5% PVIFs. Then cash flows. Here we have to add one more point. Normally, what are the cash flows? We can call them as uncertain cash flows. Now we have certainty equivalent. Now we should have certain cash flows, not cumulative cash flows, certain cash flows. Here 0, there is no uncertainty, because now also if there is uncertainty, there is nothing. What is your market research? Now there will not be any uncertainty. Now is now. So now is 45 lakhs. There is not going to be any different. Certainty equivalent now will be 1 only. So don't worry on that. So cumulative, the certain cash flows also will be same. So that multiplied with PVF now also will be 1. So same amount will be there as 0th year discounted cash flows at 5%. Now 1, 2, 3, 4. 4 years are there. Just simply 10 lakhs, 15 lakhs, 20 lakhs, 25 lakhs. So 10 lakhs, 15 lakhs, 20 lakhs, 25 lakhs. Certainty equivalent coefficient is given. In exam, all that you need to do is just copy paste all these things and then do the multiplication. 0.9, then 0.85, then 0.82, then 0.78. That is certainty equivalent. In other words, for understanding purposes, 1 lakh is uncertain cash flows, but there is a 90% certainty that 900,000 will come. So certainly how much might come? Not 1 million or 10 lakhs. It will be only 9 lakhs. That is a certain cash flows. How do we get that? Multiplying cash flows with certainty equivalent. So like that we got certain cash flows. Then we have got PVIFs already. All that we need to do is we need to multiply certain cash flows with the PVIFs that we already have. So simply after calculating all this, we will have 5 lakhs 34,570 approximately is the NPV of the project with certain cash flows. 534,570 approximately same. 534,570. That's all. So what we did here, once again to repeat, cash flows which are normally uncertain have to be multiplied with certainty equivalent so that we get certain cash flows. Then that should be multiplied with our PVIFs as we already do. But which PVIF has to be taken, which interest rate or which discount rate has to be taken, risk-free rate has to be taken. So in this case 5% is risk-free rate, so we have taken that. That's all. That is certainty equivalent approach. Again, what are the advantages here? Simple and easy to understand and apply, and it can be calculated for different risk levels also. If at all there is a different certainty equivalents, different NPVs can be calculated. But the problem, actually the biggest problem in reality is, who is going to give these certainty equivalents in reality? That is absolutely very difficult. There is no objective mathematical method to get these such certainty equivalents. So they might be subjective, and analyst can have any certainty equivalent in their mind which nobody will accept. That is why in reality nobody uses this technique. Again I am telling, reality has no bearing on your marks. Reality, why I am telling, only for understanding, which might be helpful for you in future when you really enter into the corporates. But in the examination point of view, procedure is just simple. Cash flows to be multiplied with certainty equivalents, then multiplied with PVIFs, you will get discounted cash flows, you calculate NPV. That's all. That's it. And the certainty equivalents are decided by the management normally. So the shareholders' perception is ignored. That is the problem. So these are the disadvantages of certainty equivalent. Of course, both of them are not so good. Both are traditional. But for us, from examination point of view, they are very good. Why? Because they are very simple. Risk adjusted discount rate also, certainty equivalent approach also can be very easily applied in the problems that we encounter. Now let's move on to another technique called as sensitivity analysis. And this is one of the most important techniques also from the examination point of view, because it is the most frequently asked question. So what is sensitivity analysis? Is basically a kind of modeling technique wherein we can test the sensitivity of the project's outcome, which is generally NPV, to various inputs. As we know, for any project, there will be a lot of variables which will impact the NPV, like the discount rate, the cash flows themselves, and cash flows are again impacted by various factors like selling price, variable costs, fixed costs, even depreciation rate, and even tax rate. All of them will have an impact on the cash flows and eventually on the NPV also. Same way, discount rate also will have an impact on NPV. So the point is, for the outcome what is planned, which is NPV, there are so many variables as inputs, and the risk is what these variables what have been assumed or estimated may go wrong, which might have a negative impact on NPV. Of course, each of the variables will have an impact on NPV. The question is, which variable is more influencing on the NPV? In other words, the NPV of the project, which is the outcome of the project, is sensitive to which factor? It will be sensitive to every factor, by the way, but it will be sensitive, more sensitive to which factor and less sensitive to which factors is what is analyzed in the sensitivity analysis. So simply speaking, we can call this as analyzing the impact of changes in the variables which are inputs on the outcome of the project. What is the outcome of the project? NPV. So that is the essence of sensitivity analysis. But one point to be noted here while undertaking sensitivity analysis is, at a time we have to change only one variable. All variables will not be changed at the same time. One variable at a time. We'll change it, of course. Change means what? In a good way or bad way? Of course, it has to be bad way. If it is good way, then that is not called risk. So we are searching and we are trying to understand how much risk the project has in the form of any negative changes, any dangerous changes that might happen to the input variables, how much they will impact on the outcome. Generally NPV, sometimes rarely IRR also. When one change happens of one variable at a time, how that will have an impact on the outcome is the analysis that is done, called as sensitivity analysis. Of course, we can follow these type of steps generally for taking up the sensitivity analysis. First thing first, finding out the variables which have an influence on the outcome of the project, generally NPV, and establishing the relationship between the variables and its impact on the outcome. Then analyze the effect of this change in each of the variables, again one at a time, on the outcome of the project. So that is called sensitivity analysis. As I told already, this is the most frequently asked question in the examinations. So very important technique in this chapter of risk analysis in capital budgeting. Now let us take up this illustration 7 for undertaking sensitivity analysis. X Limited is considering its new product with the following details. Initial capital cost, initial capital outlay is going to be 400 crores. Annual unit sales, not rupee sales. That means number of units, 5 crores. Selling price per unit is 100 crores. Variable cost per unit is 50 rupees per unit. Fixed costs per year total are 50 crores. You need to be very clear. Variable cost is per unit. Selling price is per unit. This is number of units. This is crores. Total fixed cost. Discount rate at which we have to discount the cash flows is 6%. With this data, what is required is, first thing first, calculate NPV of the project. First, that is called base case. NPV, which is original data being used. Then after that, compute the impact on the project's NPV of a 2.5% adverse variance in each variable. Adverse variance means if the variable goes bad by how much? 2.5%. How it will have impact on NPV, and which variable is having maximum effect. Consider the life of the project as 3 years. That is the question. Now let us first find out the base case NPV with all the details which are all given. Then we can test the sensitivity of the project by changing each variable one by one in a negative way by 2.5%. So first let us focus on base case NPV. Of course, like any other question, first thing first, we have to find out the NPV, year, then cash flows, then PVIF, then discounted cash flows, and PVIF is definitely going to be at the rate of 6%. So year 0, 1, 2, 3. Life of the project is 3 years. Year 0 cash flows are minus 400 crores. So minus 400 crores, all of them. Rupees in crores. Then cash flows for each of the years has to be calculated. For that, let us do a separate working note, taking each of the details given. Sales, first of all, in units is going to be 5 crores, that is. Then selling price as given in the question is going to be 100 rupees per unit. Variable cost per unit is given as 50 rupees. Each factor has to be taken because each of them we have to change later. That's why take each of the factors. Number of units also, selling price also, then variable cost per unit also. Then naturally what we'll get is contribution per unit, which is selling price minus variable cost per unit. So total contribution how much? Number of units 5 crores multiplied with contribution per unit 50 rupees. So 250 crores is going to be the total contribution in crores. Then fixed costs each year are going to be 50 crores. Then what is going to be profit? That is 200 crores. In this case, no tax rate is given, so we can ignore tax. Depreciation, how much, all those things are not there. So simply whatever the profit is there, that itself will be the cash flows, but not necessarily in all cases. If depreciation and tax rate are given, then profit will have to be converted to cash flows. But in this case, since those details are not there, profit will be 200 crores each year. Like that, for each year there will be a profit of 200 crores. 200, 200, 200. We can take annuity factor also, no problem. But let us just take it easily. 1 divided by 1.06. That divided by 1.06. That divided by 1.06. So let us take 3 decimals. Then discounted cash flows will be cash flows multiplied with PVIF. Then remaining things also will be similar to that. Take 2 decimals only, enough. Then total of that is 134.6. That is called base case NPV. So from the original estimation of various items, NPV looks like 135 crores approximately. If you just take the numbers, whole numbers, 135 crores is the base case NPV approximately. That is the first question answer, we got it. Now we need to recalculate it multiple times, not just once. So original NPV, base case NPV is around 135 crores, which is same 134.6 crores. That is the base case NPV. Now we need to recalculate this NPV number of times, changing each factor at a time. So let us recalculate the NPV, changing each factor at a time. For each of the factors, you may not have the time to calculate everything in the same format. So directly also you can calculate, but change has to happen in each of the factors, which will result in a change in NPV also. Change has to happen where any one factor at a time. How much? Minus 2.5%. So let us start with sales number of units. Originally projected number of units was 5 crores. If 2.5% decline in that happens, then sales in number of units will be only 4.875 crores. So once you already calculated the contribution per unit, so you don't need to show everything once again. Selling price and variable cost per unit, contribution per unit, everything will be same. Total contribution will change because sales units is not anymore 5 crores, it is 4.875 crores units. Because of that, total contribution changed, fixed cost remains same, profit has changed, the cash flows have changed now to 193.75. So change it here. Here you can use annuity factor and save time. No need to show it as a table every time, but you have to calculate NPV every time. No need to elaborately show the calculations. First one, show it properly. After that, it's only just the changes and final impact on NPV can be easily shown with the effect enough. Not required to present the same thing every time. But because the calculations are easier here, I am just doing like that continuation of the same methodology. 193.75 is the cash flows now. So 193.75 each year. Now what happened? NPV came down to 117.9. So earlier it was 134.6. Now it is 117.9. How much decrease happened in NPV? Because of a 2.5% decrease in the number of units of sales. So decrease or increase in percentage anytime can be easily taken. New divided by old minus 1. That's it. Percentage will be 12% decrease happened. Means for a 2.5% decrease in the number of units of sales, there is a 12% decrease in NPV. That is the impact of 2.5% decrease in the number of units of sales on the final NPV. That is one of the changes only. That is one thing. So let us keep it as it is. That is 12%. Now I am doing the changes here only. So here what is the NPV in the first case? Which one? This is unit sales. Change in unit sales of minus 2.5% created a new NPV of 117.9. Okay, that's it. Now recalculation once again. Now what will change? We'll take back this to 5. That will be same. That means this has to be definitely changed. How much is that? We will calculate. So sales units is going to be 5 only, 5 crores only. Selling price, let us change now. Selling price 100 rupees was originally contemplated. Now a 2.5% decrease will make it 97.5. So automatically contribution per unit changes, total contribution changes, profit also changed. Now how much is profit? 187.5. Put it here, 187.5, and you will get all the final things. So now how much is NPV? 101.2 only. So what is the percentage change here? 101 new divided by old original minus 1. That means around 25% change happened in NPV because of only 2.5% change in selling price. That means selling price reduces by 2.5% only, but total NPV reduces by 25%. So that's very sensitive. So that is selling price change. Like that, once again, all the other things. Now take it back to 100. Now variable cost per unit, negatively it has to change, means it should increase, not decrease. Dangerous thing for variable cost is not decrease. So 50 plus 2.5%. So if this becomes 51.25, then how much is going to be the profit with that change? 193.75. So 193.75. So once again, same data is there, 117.9. That means 12% change happened when there is a change in variable cost per unit, increase by 2.5%. Now take it back to the original levels. Then contribution is of course the effect of selling price and variable cost per unit, which we already tested. Now fixed cost, if it increases by 2.5%, that also negative impact on that means increase. So 2.5% now becomes 51.25. Then minus 51.25. Then 198.75. That is going to be the new cash flows and profits. So in that case, how much is going to be the NPV? 131.3. And what is the impact? New divided by old minus 1. Same. Percentage wise, that will be 2% only when there is a change in fixed cost of 2.5% increase. That's all. These are the factors we have. Sales number of units we changed and tested. Unit sales, selling price we changed and tested. Variable cost per unit we changed and tested. Fixed cost we changed and tested. Now one more change can happen, that is discount rate. Discount rate now is 6%. 2.5% negative impact on that means discount rate will increase. So 6 plus 2.5% now becomes 6.15%. See, not 6%, 6.15% will be the new PVIF if that changes. Of course, this goes back to the base case scenario. Now what changes is discount rate. So this will be what? 1.0615. 1.0615. 1.0615. Now what is the NPV? 133.1. So if the discount rate changes negatively, in the sense it increases. Bad thing on discount rate means increasing. So in that case, new NPV is 133.1. New divided by old base case minus 1. So how much percentage happened if there is a change in discount rate? Only 1% NPV has changed when the discount rate has increased by 2.5%. So when unit sales decreased by 2.5%, NPV decreased by 12%. When selling price decreased by 2.5%, NPV decreased by 25%. Variable cost per unit increased by 2.5%, NPV decreased by 12%. Fixed cost increased by 2.5%, NPV decreased by only 2%. When discount rate increased by 2.5%, the total NPV decreased by only 1%. So where the sensitivity is most, it is to the selling price. So naturally, that is the factor on which the company and management have to be more careful and watchful. That is the advantage or purpose of sensitivity analysis. That's it. That is sensitivity analysis. Finally, what is going to be the result can be looked at here. Of course, one more thing can also be taken, which is initial cash outlay. That also can be taken, right? Selling price, variable cost, everything we took. Initial cash outlay, let us say that increases by 2.5%. Then what happens? Let us change this back to old discount rate. Initial cash outlay 400 becomes, increases by 2.5% means it becomes 410. Then how it changes? Originally 134.6, now only 124.6. So how much is the change in this case? New divided by old minus 1. Percentage wise, 7% is there. So these are the new NPVs with change in each of the factors: unit sales, selling price per unit, variable cost per unit, fixed cost, discount rate, and initial cash outlay. All of them we have tested. So that is what is given here also as the end answer. So percentage change in NPV here approximately is going to be 7.43% when if the initial cash outlay increases by 2.5%, and 24.82 that is selling price change, 12.41 that is variable cost per unit change. Same thing is there for unit sales also, number of units also. 2.48% change in NPV happens when the fixed cost increases by 2.5%. Discount rate has not been tested. It can be tested also because that is also one of the input factors. So all factors, 1, 2, 3, 4, 5, 6 factors we have checked, and out of them the most influencing factor on NPV is selling price. So if selling price reduces by a mere 2.5%, the total NPV reduces by almost 25%. That means the project is more sensitive to selling price. That's it. That is how the final conclusion has to be given. So the change in selling price has the maximum effect on the NPV, almost of 25%. But point to be noted, 2 points basically. Whatever the increase or decrease we are doing, that means the effect we are doing, that has to be by same percentage. In this case, 2.5% as asked in the question, whether it is increase or decrease. For costs, 2.5% will be increased. Discount rate, it will be increased. Number of units selling price, it will be decreased. Means bad thing is what we have to look at. That is one point. Means same percentage has to be changed. That is first thing. Second, only one factor at a time has to be changed. If these two are followed, simply all that we need to do is recalculate NPV under different situations and find out which factor is most influencing on the NPV. That's it. That is sensitivity analysis. Advantages of sensitivity analysis is, first thing first, we can identify the critical factors which will have an impact on the project's success or failure, and it's a simple technique. It's only just recalculation, nothing great here. That is the advantage. And disadvantage is we are changing only one factor at a time, because we are assuming that only one factor will have impact on the NPV. So each factor is independent of each other, is the assumption, which is not likely in the real life. And probability is ignored, of course. We are not talking about statistical techniques, so naturally it will be ignored. So that is not a limitation, big thing, but yes, it is not considered also. That is the sensitivity analysis computation. Now, let us calculate some of the things which are asked in the questions related to the three techniques we learned so far. One is the risk adjusted discount rate. Second one is certainty equivalent approach. Third one is sensitivity analysis. So these three approaches we learned already conceptually. Let us apply them in some problems. Look at this illustration number 10. From the following details related to the project, analyze the sensitivity of the project to changes in only these things. You don't have to worry about which one to be tested. Initial project cost, annual cash inflow, and cost of capital. Only three things, three input things have to be changed, of course, in a bad way. And we have to recalculate the impact of, recalculate NPV and find out the impact of each of these factors on that new NPV. So that is the point here. And the base case details are given. Initial project cost is 1,20,000. Annual cash inflow is 45,000 directly given. Project life is 4 years. Cost of capital is 10%. Identify which of the three factors the project is most sensitive if the variable is adversely affected by 10%. If nothing is given, you can take any percentage. But if it is given clearly 10% adverse variance only has to be done on each variable at a time, you take 10%. And annuity factors are given already, so simply we can just use them. So it's a straightforward calculation. First thing first, let us find out base case NPV. I'm just telling the calculation directly, but presentation has to happen normally in the examinations carefully. So naturally, base case NPV is annual cash inflows, that is 45,000, multiplied with 3.169 minus 1,20,000 will be the base case NPV. So 45,000 multiplied with 3.169, all are given in the question, minus 1,20,000, 22,605 is the base case NPV. Now we have to test the impact of each of these things if they are adversely affected. So let us first take initial project cost. So now the initial project cost originally is 1,20,000. If it is adversely affected by 10%, means if it increases by 10%, how much it will become? It will become 1,32,000. So naturally, the NPV will be down by 12,000. So you can show the recalculation once again, or just reduce the NPV here by 12,000. 22,605 minus 12,000 means 10,605 will be the new NPV if initial project cost is increased by 10%. That is first thing. Second thing, annual cash inflow normally 45,000, but if it reduces by 10%, it becomes only 40,500. So now recalculate. 40,500 is the new annual cash inflows multiplied with same 3.169 minus original thing only. Every time only one variable at a time. 40,500 multiplied with 3.169 minus 120. So now the new NPV is only 8,345 approximately. That is the second factor, which is annual cash inflow adversely affected by 10%, means reduced by 10%. Then cost of capital adversely affected by 10% means it becomes 11%. 10% plus 10% on 10% is 1% only. So 11% is going to be the new cost of capital. Then what will be the NPV? Recalculate. Only what changes? What changes is the annuity factor. So originally what we calculated was 45,000 multiplied with 3.169. Now we should do only 3.103. Minus 1,20,000 remains the same. That will be original. So 45,000 multiplied with 3.103, which is the new annuity factor at 11% discount rate, minus 1,20,000 means 19,635 is going to be the new NPV if cost of capital increases by 10%, which means it becomes 11%. That's it. These are the three things which we have. Then we can find out percentage changes also as a summary. So one by one, percentage change if you calculate, new divided by old minus 1. That is a easy formula for percentage changes. So what is the percentage change? One by one if you take, three factors we have taken, only three. One is initial cost, that is initial project cost increased by 10%. So it became 10,605. Base case NPV was 22,605. New divided by old minus 1 multiplied with 100. So the total NPV reduced by around 53.1% in the first case, when initial project cost increased by only 10%. Annual cash inflow reduced by 10%. Then new NPV has become 8,345. Old NPV was 22,605 base case NPV. Minus 1 new by old minus 1 into 100 means 63.1% decrease happened. Always it will be decrease only because changes we are doing always adverse changes only. NPV will be always lesser in new cases than the base case. So 63.1 impact happened on NPV if cash flows are reduced by 10% each year. If cost of capital increased by 10%, which means it became 11%, then the new NPV became 19,635. That divided by old NPV 22,605 minus 1 into 100. So that means around 13.14%. Let us say 13.1%. That's all. So very clear, 53.1%, 63.1%, 13.1% approximately is going to be the impact on NPV due to the changes that happened. So 53, 63, 13. So which is having most impact? Naturally the annual cash flows. That is most influential on NPV. In other words, the project is more sensitive to the annual cash inflows. That is the conclusion. That's all. Such questions can be asked, were asked also for 5 marks. Many number of times, lots of times such kind of questions were asked. Okay, so that is the point here to be noted. Then also one more question is there related to sensitivity analysis. Look at this illustration 11. PNR Limited is considering a project with the following cash flows. Year 0, cost of the plant is going to be 12 crores and running cost is given, savings is given. Running cost 4 crores, so savings is 12 crores, like this for each year. 3 years data is given like in crores. Cost of capital is 12%. Measure the sensitivity of the project to changes in the levels of plant cost, running cost and savings, considering each factor at a time, such that NPV becomes 0. This is another way of doing sensitivity analysis. Now, at what level of this initial plant cost, NPV will become 0. At what level of the running cost, the NPV becomes 0. At what level of savings, the changes in the savings, the NPV becomes 0. That has to be calculated. Here we are not changing the factors by a fixed percentage. We are finding out how much percentage the original factors have to be changed so that the NPV finally becomes 0. That is another way of doing sensitivity analysis. This question is asking such type of situation. Present value factors are given at 12%. So this is the data. Determine which factor is most sensitive to affect the acceptability of the project. In other words, the project is most sensitive to which of the factors? 3 factors are asked. One is plant cost, initial cash outlay. Second one is running cost. And third one is savings. To which of these factors the project is most sensitive? That has to be calculated. That is this illustration number 11. So first let us calculate the base case NPV. Then we can see the sensitivity of each of the factors on the NPV. Same way, here cash flows, we can take rupees in crores here also. So from the data that is available, in the case of cash flows, there is going to be net cash flows only, which is the difference between savings and running cost. So here 0, 12 crores minus 12 crores. Here 1, 12 minus 4. 12 crores is saving, running cost is 4 crores. So 8 crores is going to be the net cash flows in year 1. Then year 2, 14 minus 5, 9 crores. 11 minus 6 crores. That is 5 crores for year 3. Of course, PVIF here is for 12% as given in the question. And we have to calculate for 12%. That is given, let us take them as they are given. 0.892, 0.797, 0.711. That's all. So we have these cash flows, and there is a NPV of 5.86 crores. 5 crores 86 lakhs NPV, that is base case NPV. Now we don't have to change the NPV. New NPV should be 0. We have to find out if each of the factors is changed by how much percentage, NPV becomes 0. First point, for initial project cost or cost of the plant, if it increases by 5.86 crores, NPV will become 0 because NPV is already positive 5.86 crores. So by how much percentage the initial project cost has to increase? By how much rupees it has to increase? 5.86. By how much percentage it has to increase? 5.86 divided by 12. That means if the project cost increases by around 48.8%, then NPV becomes 0. That is the first thing. That is cost of the project or cost of the plant. So the NPV divided by original initial cash outlay will give us by how much percentage it has to increase. Of course, it has to increase by 5.86 crores. If that increases by 5.86 crores, automatically NPV will become 0. So if that increases, just for testing purposes, let us say by 5.86, NPV becomes 0. That means how much percentage it should increase? 5.86 divided by 12. So 48.83% increase in cost of the plant will have made NPV 0. That is first point. Then the second one, running cost, means running cost should increase. But now what should increase? The present value of the running cost should increase. So what is the existing present value of the running cost? That can be found out. What is the existing present value of the running cost? Again, 4, 5, 6 multiplied with the respective discount factors. So running cost only, if you take separately, 4, 5, 6 crores. That multiplied with the PVIF will give us the present value of the running cost. Currently, how much is that? Around 11.82 crores is the present value of the running cost. Now, if that increases by 5.86 crores, then naturally NPV will become 0. So, how much percentage the running cost should increase? 5.86 divided by 11.82. That means running cost, if it increases by 49.58%, then the NPV will become 0. That is the second factor. Next, another factor is the savings. Saving, if it reduces by something, then NPV will become 0. By how much? For that purpose, first we should know what is the present value of the savings. 12 multiplied with the PVIF, 14 multiplied with PVIF, then 11 multiplied with the PVIF. Currently, with the base case, the present value of the saving is around 29.68 crores. That is the base case. 29.68 crores is the present value of the saving. If that reduces by 5.86 crores, present value of the savings, then the NPV will become 0. So, by how much percent it should reduce? Cost of project should increase by 48.83%, running cost should increase by 49.58%, but saving should reduce by how much percent? 5.86 divided by 29.68. So, if the saving reduces by just 19.76%, NPV can become 0. But here main point to be noted, where the project is most sensitive to which factor it is more sensitive. Here the highest percentage is not the most sensitive, lowest percentage is the most sensitive. Understand the meaning of it. If saving decreases by just 20%, then NPV becomes 0. But if the cost of the project increases by 49%, then NPV will become 0. If running cost increases by 50%, then NPV will become 0. So most sensitive is savings, because just a 20% decrease in that is enough to wipe out the NPV that we have projected. So that is the percentage change that is required for each of the factors so that NPV becomes 0. So that's what is the final answer. Around 49% for plant cost, around 50% for running cost, but only around 20% change in saving itself will wipe out the NPV, which means the NPV is going to be more influenced by savings. So the most sensitive factor here is savings. That's it. That is another way of performing the sensitivity analysis. One way is to just take some percentage negative change, some percentage. If it is given in the question, take that. If not, you assume something like 10%, whatever. That change happening to each factor, how it will have an impact on NPV. That is one way of doing it. There are multiple NPVs have to be calculated. Another way of doing is by how much percentage each factor has to be changed so that NPV becomes 0. So these are the two different ways of doing sensitivity analysis. According to the question, our answer has to be different. So in the second case, in the second type of situation, first find out the base case NPV, then find out the percentage change in each of the factors that is required so that the NPV becomes 0. That is also a possible type of question that can be expected in the examinations. Now, moving on to some of the questions which are given at the end of the chapter related to the topics that we already discussed. Let us solve them. Gaurav Limited or whatever is using certainty equivalent approach in the evaluation of risky proposals. The following information regarding a new project is given. Expected cash flow, certainty equivalent coefficient or quotient is given, and riskless rate of interest on government securities is 6%. Determine whether the project should be accepted. Simple question, 5 marks question. All that we need to do is first find out certain cash flows. So here, as usual, uncertain cash flows, which are originally given, expected cash flows, that has to be multiplied with certainty equivalent. Then what we get is certain cash flows. Then we will have PVIF. Then we will have discounted cash flows. So here 0, 1, 2, 3, 4, 5 years. First copy paste the uncertain cash flows or expected cash flows, minus 4 lakhs, then 3 lakhs 20,000, 280, 260, 240, then 160. These are normal cash flows. Then certainty equivalent, copy paste. Initially it will be 1, then 0.8, 0.7, 0.6, 0.4 and 0.3. So all that we need to do is multiply these two things. First, certainty equivalent with the expected cash flows. Do this multiplication separately. Then PVIF has to be calculated at risk-free rate, that is 6%. Of course, for year 0 it will be always 1. Then 1 divided by 1.06, that divided by 1.06, and so on. So taking only 3 decimals, this will be the PVIFs. Then discounted cash flows, multiply the certain cash flows with the PVIF, then multiply with all the other things also same way. You need to do these calculations on paper with calculator. Then total them, you get NPV. So the NPV of this particular project is going to be 2,58,839 or 840 approximately. Since the NPV of the project is positive, the project should be accepted. That's it. That will be the answer for question number 1. Of course, it will take time because you will do the calculations on the normal calculator. But accuracy is very, very important. Then moving to the second question. Following information have been retrieved from the finance department of Corp Finance Limited relating to projects X, Y and Z. Okay, 3 projects are there. Net cash outlay, initial cash outlay is 42 lakhs, 24 lakhs, 20 lakhs. Project life is 5 years. Annual cash inflows are 14 lakhs, 8 lakh 40,000 and 6 lakhs. Coefficient of variation is 2, 0.8 and 1.6. Coefficient of variation is also a measure of risk. How to calculate that is a different topic altogether, but that has no relevance here. Already it is given in this case. So you are required to determine the risk adjusted net present value of the projects, considering that the company selects risk adjusted rate of discount on the basis of coefficient of variation. So depending upon the coefficient of variation, the risk adjusted discount rate will be determined by the company. So for example, if project X has a coefficient of variation of 2, which is this, the risk adjusted discount rate to be applied for that project will be 20%. So X has to be discounted with 20%. That is the inference. Y has a coefficient of variation of 0.8. So from this table, if 0.8 is the coefficient of variation, the project has to be discounted at a risk adjusted rate of return of 12%. Everything is given. All that we need to do is pick and choose which rate is to be applied for which project according to coefficient of variation. And for project Z, the coefficient of variation is 1.6. For that, naturally, in the table given as 16% is the applicable risk adjusted discount rate. That's it. All that we need to do is find out the NPV at these risk adjusted discount rates. We are required to determine the risk adjusted NPV of each of the projects. And already the annuity factors are also given. So simple calculation, directly what we can do is for each of the projects we can find out NPV. No need of tables and all, straight away. So here 14 lakhs is going to be the annual cash inflow. So 14 lakhs multiplied with respective annuity factor. Respective annuity factor at which percentage? 20%, as we have chosen already. That is 2.990. So 2.99 minus of original cash outlay 42 lakhs. That gives the NPV for project X. Simple calculation. So 14 lakhs multiplied with 2.99 minus 42 lakhs. So project X is having a negative NPV of 14,000 rupees. That is project X. Same with project Y, but different data. Now annual cash flows is 8,40,000. That has to be multiplied with that annuity factor, which is corresponding 12% rate, which is 3.604. Minus 24 lakhs is the initial cash outlay. That gives NPV for project Y. Do the calculation. 840 multiplied with 3.604 minus of 24 lakhs. That gives 6,27,360. That is the NPV for project Y. That's it. Then project Z. Similarly, I'm doing it directly. 6 lakhs is the annual cash inflow. At what rate we have to discount? 16%. And what is the annuity factor there? 3.274. So 6 lakhs multiplied with 3.274 is the present value of cash inflows. Minus present value of cash outflows is 20 lakhs. So for project Z, there is also a negative NPV of 35,600. Negative. That is project Z. So if at all question is asking which project to be selected, project Y has to be selected. X and Z are having negative NPVs. Only Y is having positive NPV. But in this case, that was not asked. So just calculate, that's all. Calculate the risk adjusted NPV, that is enough. That is the application of risk adjusted discount rate. We are not calculating anything. The discount rate is given already. But on what basis that is chosen? On the basis of some other statistical measure called coefficient of variation. Yet to which level of coefficient of variation, which rate has to be taken is already given in the question. We have to just pick that and do the computations of NPVs according to the respective discount rate and respective annuity factors. That's it. That is question number 2. Now, moving to question number 3. The Textile Manufacturing Company Limited is considering one of the two mutually exclusive proposals, projects M and N, which require a cash outlay of 8,50,000 and 8,25,000 respectively. Certainty equivalent approach is used in incorporating risk in capital budgeting decisions. Current yield on government bonds is 6%, so it is used as risk-free rate. Expected net cash flows and their certainty equivalents are as follows for project M and project N. So all that we need to do is once again substitute and find out which is the better project by looking at its NPVs. So let us do this calculation same way like we did earlier, but of course the number of years and the discount rate could be different, but discount rate is also same, that is 6%. Cash flows will certainly be different. So let us take the cash flows correctly from the question. How many years are there here? Only 3 years are there. So 4 and 5 we don't need them. Only 3 years are there. So year 0, what is the uncertain cash flows or initial cash outlay? That will be for project M we are first calculating. Let us do that separately for project M first, then N. So uncertain cash flows means actually for year 0 the cash flows will be certain only, but it is outflow minus 8,50,000 for project M. Then cash inflows for project M are going to be 4,50,000. Then 5 lakhs, 5 lakhs. 5 lakhs, 5 lakhs. Certainty equivalent for year 0 will be 1 because now everything will be certain. Next year 0.8 same, then 0.7 same, then next year 0.5, change that. Then multiply these two things to get certain cash flows. Then multiply with the PVIF. In this case we already have 6%, so multiplication of that will give us an NPV of 11,026. That is the NPV of project M. Same thing can be done for project N also, but the cash flows will certainly change. For project N, initial cash outlay is 8,25,000 minus 8,25,000. Then first year cash flow same 4,50,000. Second year cash flow also 4,50,000. Third year cash flow 5 lakhs. Then coming to certainty equivalents, year 0 will be always 1. Year 1 it is 0.9 for project N. Then year 2 it is 0.8 for project 2, that is project N. Then 0.7 for the third year. That's it. Multiplying the cash flows with certainty equivalent will give us certain cash flows. Multiplying with PVIFs at the rate of 6% will give us discounted cash flows. Total of all of that will give us NPV. That comes to 171341. So here for project M has only an NPV of around 11,000. Project N has an NPV of 171,341. So naturally, which project has to be selected? The one with more NPV, that is project N. That is the question. So analyze which project should be accepted. Already we got the answer, that is project N. Second question, if risk adjusted discount rate method is used, identify which project would be appraised with a higher rate and why. It's a theoretical question. If at all we have to use risk adjusted discount rate, which project should be analyzed with a higher rate? Riskier project should be analyzed with higher rate. How do we know which is riskier project? By observation, certainty equivalents of project N are high. When certainty is high, that means risk is low, uncertainty is low. So project M has very less certainty equivalents each year. If you observe, each year certainty equivalents of project M are less than project N, which means certainty is less. Certainty is less means uncertainty is more. Uncertainty is more means risk is more. So naturally, project M has to be discounted with a higher risk adjusted discount rate if that approach is used. It's a theoretical question. Depending upon the risk associated with the project, it has to be discounted with a higher rate. And from the observation of the certainty equivalents, it is clear that project M is having more risk. So naturally, it is to be analyzed with a higher risk adjusted discount rate. That's all. That is the question number 3, certainty equivalence approach. Then question number 4, risk adjusted NPV is asked here also similarly like earlier question for 3 projects X, Y and Z. More or less similar question. Net cash outlays is given, project life is given, annual cash inflows is given, coefficient of variation is given. Why this coefficient of variation is given? So that according to its coefficient of variation, there is a selection of risk adjusted discount rate as this table shows. So for project X, 1.2 is coefficient of variation. That means the discount rate applicable for that project is 16%. For project Y, 0.8 is the coefficient of variation. That means discount rate applicable for that project is 14%. For project Z, 0.4 is the coefficient of variation. That means risk adjusted discount rate that is applicable for that project is 12%. All that we need to do is calculate NPV for each of the projects. Directly I'm doing, but you have to show the calculations in the examination because already everything is there. Let us take project X. 70,000 is the annual cash inflow. What should be the annuity factor used? At what rate? 16% rate. That is given 3.274. So 70,000 multiplied with 3.274 minus initial investment 2,10,000. That gives 19,180 NPV. 19,180 is the X NPV. That's it. Y. 42,000 annual cash flows multiplied with 3.433 because applicable rate is 14%. So 42,000 multiplied with 3.433 minus initial investment 1,20,000. So this gives an NPV of 24,186. Project Z. 30,000 multiplied with 3.605. 3.605 minus initial investment 1 lakh. That gives an NPV of 8150. That's what is asked. Computation of risk adjusted NPV is what is required. So X 19,180, Y 24,186, Z 8150. That's all. If at all the question is asking which project should be selected, then we can go with Y because it is giving highest NPV out of all. If that is asked. If it is not asked, don't give your valuable opinion on those things. Only if the decision or suggestion is asked, then only go for it. Otherwise, just do the computations which are asked in the question. That will be enough. So these are the major 3 techniques. One is risk adjusted discount rate. Second is sensitivity analysis and certainty equivalent approach. What we discussed in the current session, and the remaining techniques in this chapter we will discuss in the next session. Till then, take care. Bye bye. Thank you very much.